Bonds. Bonds as such एक नया investment product तो नहीं है, but it's not been very popular amongst most of us. We have heard of RBI bonds, tax-free bonds, but bonds largely still remain a mystery for us. और इसका एक reason है. The minimum amount that we need to invest in bonds generally used to be in a few lakhs, which is why this product was largely popular amongst the ultra rich in our country. लेकिन recent times में there have been bonds which start with as low as just 10,000 rupees, making it very popular and accessible for people like you and me. I believe in the coming few years bonds market is going to boom और काफी सारे options आने वाले हैं, because after all who doesn't want to get slightly better returns than their fixed deposit without taking too much risk. That's what bonds are all about, और इसके बारे में हम जानेंगे in this video where we are going to cover what are bonds, different types of bonds, and most importantly what should you check before you make an investment in bonds. Bonds actually होते क्या हैं? Bonds are nothing but loans between two parties, a borrower and a lender. Say the government or some company, they require funds. They can get these funds from the public by issuing bonds. The party which is issuing the bond, which is taking the loan, is called the bond issuer, and those who are investing in the bond or giving the loan are called the bond holders. Bonds के दो main features होते हैं, just like any other loan: interest और maturity. Interest, also known as coupon in bond lingo, is basically the rate of return that I get in exchange for giving out that loan, right? Say I invest in a bond which is 10,000 rupees, जिस पे 10% का coupon है every year. It basically means that I am going to receive an interest of 1,000 rupees every year because I have given out that loan. Maturity period means when will the bond period get over, and I will receive my initial payment, which is also known as a principal. When will I receive the principal back? Now that we know these basic terminologies, let's try to understand who are the people who are issuing these bonds and what are the different types of bonds one should be aware of. Now, bonds are basically categorized based on who is the borrower. And this information is so important for us as investors. Why? Because this will tell us how much risk we are taking by investing in the bond, isn't it? If I'm giving a loan, I obviously want to know whether this borrower is capable of paying me interest as well as my money back. So let's look at the four major types of bonds. The first one is the government bond. These are bonds issued by the central government and they come with negligible to zero risk. अगर government पैसे वापस नहीं देगी तो कौन देगा, right? So here these are bonds which one can safely consider to invest in. Government bonds are bifurcated into two types. The ones which are less than 1 year in time period are called T-bills or treasury bills. The ones which are longer than 1 year are called G-secs. The second type is the state government or the municipality bonds. Now these bonds are issued by several state governments who are looking for funding, like Andhra Pradesh state government bond, UP state government bond, and they also come with low to medium risk category. The third type is very popular for one of the reasons that they issue a lot of tax-free bonds. This third type is called the PSU bonds, the public sector undertaking bonds. Now PSUs basically are companies where government holds the majority of the ownership. So in that sense, even PSUs are fairly low risk investments. PSU bonds are issued by companies like REC, PFC, NHAI, HUDCO, so on and so forth. And like I said, they are very popular as a category of tax-free bonds. The last category is the corporate bond. Now these are private companies like Edelweiss, Cholamandalam, Muthoot Finance, HDFC, Mahindra and Mahindra, which have come out also with a set of bonds. These are the ones which typically come with very low entry price or a low ticket size of 10,000, 20,000, 25,000 rupees. But mind you, this is also the high risk category of bonds. So before investing in corporate bonds, one should be fairly cognizant and cautious to understand what are the main things that they should check before they invest their money here. The first factor to consider while buying a bond is the credit rating of the bond. So when you're looking at the ad or the brochure, you'll see something written as credit rating. It'll have some alphabets like AAA, A plus, stuff like that. Credit rating is basically a score which is given to check the financial stability of the borrower. Can I get my money back? Is this borrower stable or not? And these ratings are typically given by third party agencies. So you would have heard of CRISIL, ICRA, CARE. All these parties are evaluating whether it's safe for me to invest or not. Pro tip, as a first time investor, go after AAA or AA rated bonds. These could be considered to be fairly safe. The second criteria to check is the time period or the tenure of the bond. Well, you're locking your money in, so you obviously want to know whether it's matching your certain goals or not. Also, if you're a first time investor, I would suggest go for 2 to 4 year kind of bonds, not a very long term bond, because you must understand that long term investing in bonds requires some understanding of interest rate movements. If you want to know how exactly are bond prices and interest rates connected, tell me in comments and I'll make another video about it. The third thing to consider is the interest rate. Of course, how much return am I going to make on the bond, right? So how does one check whether this is worth an investment or not? I suggest compare it to alternatives. Are you going to invest this money in fixed deposit? Then look at whether this bond is giving you at least 1.5 to 2% higher return than what you're getting in a fixed deposit. Only then is it worth taking that little extra risk. Also here, point to note is the interest frequency. How often will I get the interest? If you're someone who's looking for a regular payout, then looking at a monthly or a quarterly payout kind of a bond might make more sense. If you're someone who's just parking this money and don't want any regular income, then consider the cumulative interest which you get at the end of the time period with the final principal. The next criteria to check is whether this is the secured or an unsecured bond. So understand carefully, a secured bond basically means that this borrower has issued a bond against some assets they already hold. In our life, you can connect this with a gold loan. So if I take a gold loan, typically I will pledge my gold, I will give my gold to the bank, and against that I will get some loan, right? So what happens if I don't pay that loan? The bank will use my gold and recover the money. Similarly, in a secured bond, if anything happens, if there's an issue with the finances of the company, they will sell off those assets and repay us as bondholders, right? In case of an unsecured bond, we are at a higher risk because such a case, such a situation, such a repayment cannot happen. So I would suggest going after secured bonds. And finally, check the minimum investment. To get started, private bonds start with 10,000. Generally, state government bonds, central bonds might start at a higher price. What I recommend here as a pro tip is if you have say 5 lakh rupees already in your safe portfolio like in your FDs, you can start by considering bonds as 5 to 10% of this amount. So maybe out of that 5 lakhs, 50,000 you can allocate towards this particular asset and see how it works out for you. So in a summary, an ideal starting point for a first time bond investor would look something like this. A central state or a PSU bond, which is of a time period of 2 to 4 years, giving me 1.5 to 2% more return I would make in a FD, and which is a secured bond, right? Once you find such a bond, it can be a great starting point for you. At Womoneysta, we are passionately working to enable every woman to take charge of her finances. And personally, I feel bonds is a beautiful product for a lot of us who have just ended up stashing away our money in fixed deposit and are too scared to take too much risk, and we are not diversifying. So if you want to learn how to get started, don't miss out. Book a free one-on-one consultation with our team of women experts. I'm putting the link in the description. Book your free 15 minutes now. And if you like this video, please tell me what more you want to learn around bonds or any other topic in money in the comment section, and I'm going to come back with that video. Meanwhile, don't forget to subscribe to Womoneysta. I'm Neha Singh signing off, and I'll see you soon.